Stop trading hours for money, build assets that pay you forever. You wake up at 6 a.m. Commute for an hour. Work for 8 or 9 hours. Commute back. Collapse on the couch. Repeat tomorrow. And the moment you stop, the money stops. That is not freedom. That is a trap with a salary attached. Here is what most people never realize. The game changed. The old formula of work hard, save 10%, retire at 65 stopped working decades ago. But nobody updated the instruction manual. So millions of people are still playing by rules that guarantee they will never win. This audiobook is about the new rules. The ones that actually work. The ones the wealthy have been using while everyone else traded hours for dollars and wondered why they stayed broke. You are going to learn how to build assets. Real assets that generate cash flow whether you show up or not. Assets that pay you while you sleep, while you travel, while you spend time on things that actually matter. And you do not need a trust fund to start. You need clarity. You need the right framework. And you need to stop doing what everyone else is doing. Later in this audiobook, I will give you the 2-minute version. A simple action you can take today that starts building your first asset immediately. I will also give you the 7-day Rewire Plan, a step-by-step checklist that transforms you from wage earner to asset builder in 1 week. And here is the best part. You do not need to pause or take notes right now. There is a free toolkit in the description with every framework, every tool, and the complete 7-day checklist. You can use it later when you are at your desk. So just listen. Let this sink in. And by the end, you will see money completely differently. If you are ready to stop trading time for money and start building wealth that lasts, stay with this. The system is designed to keep you trapped. Let me tell you what nobody wants to admit. Your job is not designed to make you wealthy. It is designed to keep you dependent. You trade your time for money. And when you run out of time, you run out of money. That is the deal. That is the trap. And the worst part? Most people think this is normal. They think this is how it works. Get a degree, get a job, work your way up, save a little, retire broke. That was the path for your grandparents. It barely worked for your parents. And it is completely broken for you. The world shifted. Technology changed everything. But the workforce playbook stayed the same. So now you have millions of people working harder than ever, earning more than ever on paper, and still living paycheck to paycheck. Here is what changed. The old currency was labor. The new currency is ownership. The old game was climbing someone else's ladder. The new game is building your own ladder and charging rent to anyone who uses it. Think about the people you know who seem financially comfortable. Not trust fund kids. Not lottery winners. Regular people who just seem to have figured it out. What do they have in common? They own things. They own rental properties that generate monthly income. They own digital products that sell while they sleep. They own businesses that operate without their constant presence. They own stocks that pay dividends every quarter. They built systems. They created assets. And those assets produce cash flow whether they work or not. Meanwhile, most people are still trading hours for dollars. And wondering why they never get ahead. Your salary is a ceiling. It does not matter how impressive it looks. It does not matter if you get a raise every year. There are only so many hours you can work. And there is only so much any employer will pay you. But assets? Assets have no ceiling. One rental property generates $500 per month. 5 rental properties generate $2,500 per month. 20 rental properties generate $10,000 per month. Same work. Different scale. One digital product sells 10 times and makes $500. The same digital product sells 1,000 times and makes $50,000. Same product. Different reach. That is leverage. That is how wealth actually works in the modern economy. The pandemic proved this in the harshest way possible. Millions of people lost their jobs overnight. Their income disappeared instantly. But people who owned assets? They survived. Some even thrived. Because assets do not get laid off. Here is the truth nobody wants to say out loud. You are either building assets or you are being used as an asset in someone else's system. Your employer uses your labor as an asset to generate profit. Your landlord uses their property as an asset to collect your rent. The software company uses their platform as an asset to extract your subscription fee. Everyone is building assets and extracting value. Except you. You are still selling your time. And the beautiful irony? Building assets has never been easier. The barriers are lower than they have ever been in human history. You do not need millions in capital. You do not need family connections. You do not need a fancy degree. You need knowledge. You need strategy. And you need to stop playing by the old rules. The tools exist. The platforms are live. The opportunity is massive. But you have to recognize that the game changed. And playing by the old rules will only take you further into the trap. Here are the new rules. Build things that pay you repeatedly. Create value once and monetize it infinitely. Use technology and systems to multiply your impact without multiplying your effort. Stop selling your time and start selling solutions. This is how modern wealth is built. This is the path we are walking together. What actually counts as an asset? You have been lied to about assets. Not maliciously. Just culturally. Society told you certain things were assets when they were actually liabilities dressed up to look impressive. Here is the only definition that matters. An asset puts money in your pocket every month without requiring your active labor. Notice what is missing from that definition. It does not say anything with value. It does not say anything you own. It says anything that generates cash flow. This distinction changes everything. Your house? The one you live in? The one you are so proud of? That is not an asset. That is a liability. Every month it demands a mortgage payment, property taxes, insurance, maintenance, utilities. It takes money out of your pocket. Yes, it might appreciate. Yes, you might sell it for profit decades from now. But until that moment, it is consuming your wealth, not creating it. A rental property that generates more income than its expenses? That is an asset. Your primary residence? That is a place to live. And there is nothing wrong with that. But stop pretending it is building your wealth. Your car depreciates the moment you drive it off the lot. It requires insurance, fuel, repairs, registration fees. Every month it takes money from you. That is a liability, not an asset. But a vehicle used in a business that generates more revenue than its total costs? Now we are talking about an asset. Context matters. Function matters. Cash flow is the only metric that counts. Here is where it gets interesting. Real assets come in forms most people never consider. A website that generates advertising revenue while you sleep is an asset. An online course you created once that sells automatically is an asset. A patent that produces licensing fees is an asset. A portfolio of dividend-paying stocks that deposits money into your account quarterly is an asset. A business with systems that operate without your daily involvement is an asset. Notice the pattern. They all produce income without consuming your time. Digital assets have become the most powerful wealth generators of our era because they scale infinitely with minimal cost increases. Create a digital product once, sell it 10,000 times. Build an audience once, monetize it through multiple streams indefinitely. Write valuable content once, let it generate traffic and revenue for years. The marginal cost of serving one more customer approaches zero. Which means the profit potential approaches infinite. But here is the trap that catches even sophisticated people. Some things masquerade as assets but are actually speculation dressed up in fancy clothes. A stock you are hoping will go up in price but pays no dividend? That is speculation, not an asset. Cryptocurrency you are holding for potential future value? Speculation. Raw land that generates no income while you pay taxes on it? Liability. Gold bars in a safe deposit box? Store of value perhaps, but not an asset in the cash flow sense. They might be part of a diversified strategy. But do not confuse them with things that actually pay you. The psychology shift required here is profound. You have to train yourself to ask one question about everything you consider buying or investing in. Will this put money in my pocket every month, or will it take money out? If the answer is unclear, you are probably looking at a liability. The wealthy think in cash flow. The middle class thinks in net worth. The poor think in paychecks. Where you focus determines where you end up. Understanding this distinction is liberating because it completely reframes your financial decisions. Suddenly you are not impressed by someone's expensive car or big house. You are curious about their monthly cash flow. You are not chasing status symbols. You are building income streams. You are not asking how much something costs. You are asking how much it pays. This is the lens through which every financial decision should be filtered from this moment forward. If you are driving or working out, just listen. The toolkit has the full breakdown of asset types with specific examples you can reference later. The millionaire mindset, thinking in systems, not salaries. There is an invisible wall that separates the wealthy from everyone else. And it is not made of money. It is made of thought patterns. Two people can have the same education, the same starting capital, even the same opportunities. And one will build lasting wealth while the other stays perpetually broke. The difference is not intelligence or luck. It is the operating system running in their mind. Most people have been programmed since childhood to think in terms of salary. What do you want to be when you grow up? How much does that job pay? What is your starting salary? What is the raise structure? The entire framework is built around trading time for money in a linear relationship. Work 40 hours, get paid for 40 hours. Want to make more? Work more hours or get a raise. But there are only so many hours. And raises have limits. This mental model has a ceiling built into its foundation. The millionaire mindset operates on completely different logic. It asks, how can I create value once and get paid for it repeatedly? How can I build a system that generates income without my constant presence? How can I leverage technology or other people's time or capital to multiply my impact? Instead of thinking in hours and wages, they think in streams and systems. Instead of asking for a raise, they ask how to buy or build another asset. This shift feels uncomfortable at first because it requires you to see yourself differently. Employees think, I need security, benefits, a steady paycheck. Owners think, I need skills, systems, and assets that produce cash flow. Employees ask, what is the job worth? Owners ask, what is the business worth? Employees save money. Owners invest money into things that multiply it. The employee mentality seeks to minimize risk. The owner mentality seeks to maximize opportunity while managing risk intelligently. Here is where the psychology gets fascinating. Most people experience anxiety about money because they have one income stream: their job. And if that disappears, everything collapses. Their entire financial life balances on a single point of failure. People with the millionaire mindset feel progressively more secure as they add more income streams. Not because they are working more, but because they are building redundancy into their financial architecture. Lose one stream? They still have 5 others flowing. That is not just financial security. That is psychological freedom. The cash flow thinker looks at every dollar differently. Instead of seeing money as something to spend or save, they see it as seed capital. Every $1,000 is a potential down payment on a rental property, the starting capital for a digital business, the investment in a skill that will pay dividends for decades. They delay gratification not because they are miserable, but because they understand compound growth. They know that the coffee money invested today becomes real estate income tomorrow. They are playing a different game with different rules and different rewards. This mindset also changes how you value your time. If you make $50 an hour at your job, that feels like good money. But if you spend 10 hours building a digital product that then generates $50 a week for the next 5 years, you just earned $13,000 from that initial 10-hour investment. That is $1,300 per hour of effective compensation. Suddenly your time calculation changes. Suddenly trading hours for dollars feels like the worst deal imaginable. The transformation happens when you stop seeing yourself as a worker and start seeing yourself as a wealth-building enterprise. You are not just a person with a job. You are a corporation with multiple divisions, each designed to generate revenue. Your skills are products. Your knowledge is intellectual property. Your networks are distribution channels. Your investments are acquisitions. You become the CEO of your own financial future. And CEOs do not think in salaries. They think in equity, cash flow, and asset appreciation. People with employee mindsets wait for someone to give them opportunity. People with owner mindsets create opportunity. Employees ask permission. Owners ask forgiveness. Employees optimize for job security. Owners optimize for option value. Employees fear change. Owners leverage change. The mindset determines the strategy, and the strategy determines the outcome. You cannot build millionaire results with employee thinking. The math simply does not work. Quick recap, and remember, the toolkit is there so you can revisit this without rewinding. We covered the trap of trading time for money, the real definition of assets versus liabilities, and the mindset shift from employee to owner. If you only do one thing from this audiobook, start asking this question about every financial decision: will this put money in my pocket every month, or take money out? That one filter will change everything. Now let us talk about the most powerful wealth-building tools of the 21st century. Tool 1. Digital products that sell while you sleep. Here is what makes digital products the ultimate asset. You create them once. You sell them infinitely. And the cost of serving customer number 10,000 is basically the same as serving customer number 1. That is leverage at a scale previous generations could not have imagined. Think about physical products. You need raw materials, manufacturing, inventory, warehousing, and shipping for every single unit. Your costs increase linearly with every sale. But digital products? Create an ebook, an online course, a software tool, a template pack. Sell it once or sell it 1,000,000 times. Same infrastructure. Same product. Infinite scale. This is how ordinary people build extraordinary wealth in compressed time frames. Your knowledge is the raw material. The internet is the factory. Everything you know how to do, every problem you have solved, every skill you have mastered can be packaged into digital products. The expert gardener creates an online course. The graphic designer sells templates. The business consultant records their methodology into a membership site. The fitness coach builds a training app. The writer publishes ebooks. Each one is creating an asset that works independently of their physical presence. Here is how you actually do this. Step 1. Identify the problem you solve better than most people. What do people ask you for help with? What do you do that others find difficult? That is your knowledge gap. That is your product opportunity. Step 2. Package your solution into a structured format. Not just random advice. A clear framework. A step-by-step process. A repeatable system. Step 3. Choose your delivery method. Video course on a platform that handles payments and delivery. PDF guide sold through your website. Membership site with ongoing content. Software tool that automates your solution. Step 4. Create it once with quality. Not perfection. Quality. Good enough to solve the problem. Refined enough that people feel they got value. Step 5. Set up automated delivery. When someone pays, they get instant access. No manual fulfillment. No customer service overhead for delivery. Step 6. Drive traffic through content. Blog posts, YouTube videos, social media, search optimization. Create free value that demonstrates your expertise and points to your paid product. Here is the 7-day mini-experiment for digital products. Day 1. List 3 problems you can solve that people would pay to fix. Be specific. Not vague concepts. Day 2. Choose one problem and outline a 5-step solution framework. Just the structure. Not the full content yet. Day 3. Research where your target audience already hangs out online. Reddit communities, Facebook groups, YouTube channels, forums. Day 4. Create one piece of free content that solves a small part of the problem. A blog post, a video, a social media thread. End it with a mention that you are building a full solution. Day 5. Validate demand. Post your content. See if people engage. Ask if they would be interested in a complete guide. Day 6. If you get positive signals, create a simple landing page describing your product. Not the full product. Just the description and a pre-order or waitlist option. Day 7. Share the landing page in the same places you shared your free content. Track how many people sign up. That is your validation. If you get 50 people on a wait list from a simple landing page, you have a viable product. Now you actually build it. Common failure mode. Creating a product nobody wants and wondering why it does not sell. The fix. Validate demand before building. Test interest with free content and pre-orders. Only create the full product after you have proven people will pay for it. Digital products are the gateway asset. Low startup cost. Fast to create. Infinite scaling. And they teach you the fundamentals of building things that generate passive income. If this is useful, subscribe, like, and turn on the notification bell. It helps more people find these audiobooks. Tool 2. Content platforms that generate perpetual traffic. Content is the most undervalued asset in existence. A well-crafted blog post can generate traffic and revenue for years. A YouTube video continues attracting views and advertising money indefinitely. A podcast episode becomes a permanent part of your library discovered by new audiences years after you recorded it. This is compound interest applied to content. Create once, benefit repeatedly. Most people understand this intellectually but fail to execute because they are stuck in hourly wage thinking. They cannot see how today's content becomes tomorrow's cash flow. Here is how content platforms actually work as assets. You create valuable content consistently. That content ranks in search engines or gets recommended by algorithms. People discover it months or years later. The content drives them to your products, services, affiliate offers, or advertising revenue. The more content you create, the more entry points you have. The more entry points, the more traffic. The more traffic, the more revenue opportunities. And here is the magic. Old content keeps working while you create new content. They stack. They compound. Month 1, you publish 10 pieces of content. They generate 1,000 visitors. Month 2, you publish 10 more pieces. The new content generates 1,000 visitors. But the old content is still generating 800 visitors. Total is 1,800. Month 3, you publish 10 more. New content generates 1,000. Month 2 content generates 800. Month 1 content generates 600. Total is 2,400. The growth is not linear. It is cumulative. By month 12, you have 120 pieces of content all generating traffic simultaneously. That is the compounding power of content platforms. Here is how to build this asset. Step 1. Choose one platform and commit to it for 12 months minimum. YouTube, a blog, a podcast, LinkedIn, Twitter threads. Pick one. Master it before spreading yourself thin. Step 2. Identify your content pillars. 3 to 5 topic areas you will create content about. Specific enough to attract a defined audience. Broad enough to create hundreds of pieces. Step 3. Create a sustainable publishing schedule. 2 videos per week. 1 blog post per day. 5 Twitter threads per week. Whatever you can maintain consistently without burning out. Step 4. Optimize for search and discovery. Use keywords people are actually searching for. Create titles that promise clear value. Deliver on the promise in the content. Step 5. Monetize through multiple streams. Advertising revenue, affiliate links to products you recommend, your own digital products, sponsorships, consulting inquiries. Step 6. Analyze what works and do more of it. Track which content gets the most views, the most engagement, the most conversions. Create more content on those topics. Here is the 7-day mini-experiment for content platforms. Day 1. Choose your platform and create your account. Set up your profile professionally. Write a clear bio that explains what value you provide. Day 2. Research the top 10 creators in your niche. Analyze their most popular content. What topics resonate? What formats work? What gaps exist? Day 3. Brainstorm 30 content ideas. Specific topics, clear titles, obvious value propositions. You want a backlog so you never feel stuck. Day 4. Create your first piece of content. Do not overthink it. Make it valuable and ship it. Day 5. Create and publish your second piece of content. You are building the habit of consistent creation. Day 6. Engage with other creators and audiences in your niche. Comment thoughtfully. Add value. Build relationships. This drives initial visibility. Day 7. Review your analytics. See what is working. Adjust your next content based on real data, not assumptions. Common failure mode. Creating inconsistently, giving up after a few weeks when results are not immediate. The fix. Commit to a 12-month minimum timeline. Content platforms are slow to build but incredibly valuable once established. Treat it like planting an orchard. You water it every week for a year before you taste fruit. Content platforms are freedom machines. They generate traffic while you sleep. They build your audience without your constant presence. They create opportunities you never have to chase. And the best part? You can start today with zero capital. Tool 3. Rental properties that tenants pay off for you. Real estate has built more millionaires than any other asset class in history. And the reason is simple. You use other people's money to buy an asset that other people pay off for you while it appreciates. Let me break down the mechanics. You buy a property for $300,000. You put down $60,000 and finance $240,000. Your mortgage payment is $1,500 per month. You rent the property for $2,500 per month. After taxes, insurance, maintenance reserves, and property management, you are netting $500 per month in positive cash flow. That $500 goes into your pocket every month. But that is not where the wealth is actually built. Your tenant is paying your $1,500 mortgage. That mortgage payment includes principal paydown. Every month your loan balance decreases and your equity increases. In year 1, maybe $400 per month goes toward principal. That is $4,800 in equity gained. In year 10, maybe $800 per month goes toward principal. That is $9,600 in equity gained. Over 30 years, your tenant pays off the entire $240,000 loan. You now own a $300,000 asset that cost you $60,000. And during those 30 years, the property likely appreciated. Maybe it is worth $500,000 or $600,000 now. Plus you collected $500 per month in cash flow for 360 months. That is $180,000 in total cash flow. So your $60,000 down payment turned into $600,000 in property value plus $180,000 in cash flow. And you barely did anything. The tenant paid the mortgage. The property appreciated naturally. The system worked. Now imagine you own 5 properties. Or 10. Or 20. This is how real estate builds generational wealth. Here is how to actually execute this. Step 1. Get your finances in order. You need good credit, stable income, and capital for a down payment. Work on all 3 simultaneously. Step 2. Research your market. Not every market works for rental properties. You need areas where rent prices support mortgage payments with positive cash flow. Step 3. Run the numbers on every property. Purchase price, down payment, mortgage payment, property taxes, insurance, estimated maintenance, property management fees. Then estimate rental income. If the numbers do not work, pass. No emotional decisions. Step 4. Buy your first property. Use conventional financing if possible. 20% down gets you the best rates. Less than 20% means mortgage insurance, which cuts your cash flow. Step 5. Find good tenants. Screen thoroughly. Credit check, income verification, references. A bad tenant destroys your cash flow and creates stress. Step 6. Manage or delegate management. If you are local and handy, self-management saves money. If you are busy or distant, hire property management. They take 8 to 10% of rent but handle everything. Step 7. Use cash flow and equity to buy property number 2. Then 3. Then 4. Each property makes the next one easier because you have cash flow and you are building a track record. Here is the 7-day mini experiment for rental properties. Day 1. Calculate how much capital you can access for a down payment. Savings, investment accounts, retirement account loans. Get a real number. Day 2. Research 3 markets where you might invest. Look at median home prices, median rents, economic growth, population trends. Day 3. Use online calculators to model property purchases in each market. Input real numbers from current listings. See where the math works. Day 4. Connect with a real estate agent who specializes in investment properties in your target market. Tell them your criteria. Ask them to send you listings. Day 5. Analyze 5 properties using the numbers. Calculate cash flow after all expenses. Reject anything that does not cash flow positively. Day 6. Visit your local bank or mortgage broker. Get pre-approved for a loan. Understand your borrowing capacity and interest rates. Day 7. Make a decision. Are you ready to buy in the next 90 days? If yes, start making offers. If no, identify what is blocking you and create a plan to fix it. Common failure mode. Buying a property that looks good on paper but does not actually cash flow because expenses were underestimated. The fix. Be conservative with your projections. Assume higher maintenance costs, higher vacancy rates, higher property management fees. If it still cash flows, buy it. If it only works with optimistic assumptions, pass. Real estate is not passive in the beginning. It requires work to buy, set up, and stabilize. But once stabilized, it is one of the most reliable cash flow generators in existence. And unlike digital assets, real estate is tangible. Banks lend against it. It survives economic chaos. It provides both cash flow and appreciation. If you are serious about wealth, real estate is not optional. It is foundational. Tool 4. Dividend stocks that pay you quarterly. Dividend stocks are the quiet wealth builder that nobody talks about because they are boring. No hype. No get-rich-quick stories. Just reliable companies that pay you every quarter for owning shares. And boring is exactly what makes them powerful. Here is how dividend investing works. You buy shares of companies that distribute a portion of their profits to shareholders. These distributions are called dividends. A company might pay $2 per share per year in dividends. If you own 100 shares, you receive $200 per year. If you own 1,000 shares, you receive $2,000 per year. The best dividend companies increase their payouts every year. They are called dividend aristocrats. These are companies that have raised dividends for 25 consecutive years or more. So that $2 per share becomes $2.10 next year. Then $2.20 the year after. Your income grows automatically without you doing anything. Here is why this matters. A $500,000 portfolio of dividend stocks yielding 4% annually generates $20,000 per year in passive income. You do not have to sell shares. You do not have to time the market. You just collect the dividends and live on them. During your accumulation years, you reinvest those dividends to buy more shares. This creates compound growth. During your retirement years, you take the dividends as cash and use them to fund your life. The principle stays intact. The wealth gets passed to your kids. That is how old money stays wealthy across generations. Here is how to build a dividend portfolio. Step 1. Open a brokerage account. Any major platform works. Fidelity, Schwab, Vanguard. Choose one and fund it. Step 2. Focus on dividend aristocrats and blue-chip dividend pairs. These are established companies with long histories of profitability and dividend growth. Johnson & Johnson, Coca-Cola, Procter & Gamble, 3M, McDonald's. Step 3. Diversify across sectors. Do not put everything in one industry. Spread it across consumer staples, utilities, healthcare, financials, industrials. Step 4. Reinvest dividends automatically. Every platform offers dividend reinvestment plans. Turn it on. Your dividends buy more shares which generate more dividends. Step 5. Add capital consistently. Monthly or quarterly contributions. Dollar cost averaging smooths out market volatility and builds your position steadily. Step 6. Ignore short-term price fluctuations. You are not buying stocks to sell them next month. You are buying income streams. If the dividend keeps coming, the share price does not matter. Step 7. Monitor dividend safety. If a company cuts its dividend, that is a red flag. Sell and reallocate to more stable pairs. Here is the 7-day mini-experiment for dividend investing. Day 1. Open a brokerage account if you do not have one. Fund it with whatever capital you can allocate. Day 2. Research the current dividend aristocrats list. Read about 5 companies you recognize and understand. Day 3. Check the dividend yield and payout history for each company. Look for consistent or growing dividends over the past 10 years. Day 4. Choose one company and buy your first shares. Even if it is just 1 or 2 shares. The goal is to start. Day 5. Set up automatic dividend reinvestment for all holdings. This ensures dividends buy more shares automatically. Day 6. Calculate how much you can invest monthly. Even $100 per month compounds significantly over decades. Day 7. Schedule automatic monthly investments. Set it and forget it. Consistency beats timing. Common failure mode. Selling dividend stocks during market downturns because the share price dropped, missing out on decades of dividend growth. The fix. Remember, you are buying income, not share price appreciation. As long as the dividend is safe and growing, hold through volatility. The best buying opportunities happen when everyone else is panicking. Dividend stocks will not make you rich next month, but they will make you financially independent over decades. They are the foundation of a portfolio that generates income without selling assets. And combined with real estate and digital assets, they create the diversified cash flow portfolio that funds the life you actually want. This is exactly what the toolkit is for. So keep listening now, then use the checklist later when you are at your desk. The 2-minute version. Do this today. You have listened to frameworks, tools, and strategies. But knowledge without action is just entertainment. So here is what you do today. Right now. In the next 2 minutes. Step 1. Open a notes app on your phone or grab a piece of paper. Step 2. Write down every source of income you currently have. Salary, side gig, freelance work, whatever. List them all. Step 3. Next to each income source, write whether it requires your active time or if it continues without you. Be honest. Step 4. Circle the ones that continue without you. Those are your assets. Everything else is trading time for money. Step 5. At the bottom, write this question: what is one asset I can build in the next 90 days? That is it. 2 minutes. But here is what just happened. You took inventory of your current reality. You identified the gap. And you committed to building your first asset. That clarity is the starting point for everything that comes next. Most people never take this step. They consume information and do nothing. You are different. You just proved it. Now let's talk about the 7-day plan that transforms you from wage earner to asset builder. The 7-day Rewire Plan. This is your implementation roadmap. 7 days. 7 actions. Each one builds on the previous. By the end of this week, you will have shifted from passive listener to active builder. Day 1. Complete the 2-minute audit. List your income sources. Identify which are assets and which are time trades. Write your 90-day asset goal. Time commitment, 5 minutes. Day 2. Choose your asset category. Digital product, content platform, real estate, or dividend stocks. Pick one. You can add others later. Right now, pick one. Time commitment, 10 minutes. Day 3. Research your chosen asset type. Read 3 articles or watch 3 videos from credible sources. Understand the basics. Learn from people who have done it successfully. Time commitment, 30 minutes. Day 4. Create your action plan. Write down the specific steps required to build your first asset in your chosen category. Be concrete. Not vague intentions. Actual steps. Time commitment, 20 minutes. Day 5. Take the first action. If you chose digital products, outline your product. If you chose content platforms, create your first piece of content. If you chose real estate, calculate your down payment capacity. If you chose dividend stocks, open your brokerage account. Time commitment, 30 minutes to 1 hour. Day 6. Eliminate one expense that does not serve your goals. Cancel a subscription. Skip a luxury purchase. Redirect that money toward your asset fund. Time commitment, 10 minutes. Day 7. Schedule your next 3 actions on your calendar. Not a vague to-do list. Actual calendar blocks with specific tasks. This creates momentum. Time commitment, 10 minutes. Total time investment for the week, less than 3 hours. But the impact is infinite. You just went from consumer to creator. From employee mindset to owner mindset. From hoping for wealth to building it systematically. The toolkit in the description has this entire checklist formatted and ready to use. Download it. Print it. Check off each day as you complete it. And share this with one friend who is tired of trading hours for money. Once they learn to build assets, they will stop feeling trapped and start feeling free. Closing, your new reality. You started this audiobook trading hours for money. You are ending it with a different operating system. You now understand the difference between assets and liabilities. You know that the wealthy do not work harder. They own systems that work for them. You have frameworks for digital products, content platforms, rental properties, and dividend stocks. You have the 2-minute version to take action today. You have the 7-day Rewire Plan to transform this week. And you have a choice to make. You can close this audiobook and go back to the same patterns. Wake up tomorrow and trade your time for money. Stay on the paycheck treadmill. Hope it works out. Or you can decide right now that you are done with that game. You can commit to building your first asset in the next 90 days. You can shift your identity from worker to owner. You can start creating wealth that lasts instead of income that stops the moment you stop. The path is clear. The tools exist. The opportunity is real. The only question is whether you will walk it. Thank you for listening. Subscribe, like, and turn on the notification bell. Check out the free toolkit in the description so you do not have to take notes. And share this with one friend who is stuck trading time for money. Once they build their first asset, they will finally understand what financial freedom actually means. Your new reality starts now.